Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about DPC DASH interim report. DPC DASH Limited offers a variety of businesses and services through its subsidiaries in the People's Republic of China. These include fast food restaurants, restaurant management, dough production, warehousing services, sales of fast food products such as plus pizza, plus chicken products, plus beverages. The significant increase in DPC DASH's stock price over the past year can be attributed to several key factors. The company's strong financial performance and profitability have been a major driving force, with robust revenue growth and improved net profits. Additionally, DPC DASH's aggressive store expansion strategy has paid off, with the company crossing the 1,000-store milestone in 2024 and continuing to expand into new markets. The company's operational excellence and market leadership have also contributed to its success, with 28 consecutive quarters of positive same-store sales growth and a strong position within the Domino's global system. Analyst endorsements and a positive outlook from investors have further fueled confidence in the stock, with consensus estimates predicting significant revenue and earnings growth in 2025. Overall, DPC DASH's combination of financial strength, operational excellence, and market leadership has driven its stock price increase over the past year, making it an attractive investment opportunity for those looking to capitalize on China's growing pizza market. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by the continued national store network expansion, strong sales generated at new stores in new markets, and positive same-store sales growth in existing markets. This has resulted in a 27% year-over-year increase in revenue. On the other hand, the primary driver of revenue decline is the negative same-store sales growth impact from new markets entered since December 2022, which has resulted in a 1% decline for the 6 months ended June 30, 2025. Additionally, the average daily sales per store declined by 4.4%, mainly due to the stabilization of high-performing stores. The expansion of the store network and increase in staff compensation expenses have also contributed to revenue growth, while the negative same-store sales growth from new markets has led to a decline in revenue. Net income and profit margins overview. The financial summary reveals significant fluctuations in net income and profit margins across various periods. Notably, net income experienced a substantial increase of plus 504.4% on page 5, followed by a year-over-year growth of plus 79.6% on page 10. However, this trend reversed on page 19, with a decline of minus 15.7 million. Profit margins also underwent changes, with adjusted EBITDA margin improving from plus 11.4% to plus 12.4% on pages 5 and 10. Store-level operating profit margin saw a slight increase from 14.5% to 14.6% on page 10. Adjusted net profit margin rose from 2.5% to 3.5% on pages 5 and 17. The varying changes in net income and profit margins suggest that the company's financial performance is subject to fluctuations, with some periods experiencing significant growth while others show decline. The company's financial performance indicates a strong ability to generate cash from its core operations. The net cash generated from operating activities for the year 2025 is consistently reported as RMB 361.1 million and RMB 361,146 on pages 19 and 45 of the financial summary, respectively. This positive operating cash flow demonstrates the company's efficiency in managing its resources and generating revenue. The company's debt level and interest expenses have undergone significant changes in the recent period. In terms of debt level, while total borrowings remained unchanged at RMB 100 million, non-current liabilities increased by a substantial amount from RMB 0 to RMB 199,600. On the other hand, current liabilities saw a decrease in both borrowings and trade payables. Regarding interest expenses, finance costs net rose by 23.9% to RMB 34.6 million, while total interest expenses increased by 12.1% to RMB 43,618. The breakdown of interest expenses reveals that bank borrowings decreased by 17%, whereas lease liabilities surged by 16.2%. These changes indicate a shift in the company's debt structure and its associated costs. Management is emphasizing a customer-centric approach by investing in effective engagement and marketing campaigns to expand the customer base. The company plans to achieve this through digital adoption and store network growth, with a focus on opening 300 new stores by 2025. Additionally, management will prioritize loyalty program growth and closely monitor foreign exchange risks to ensure financial stability. The company's financial summary reveals that it has not distributed any dividends to its shareholders. Furthermore, there is no indication of share buybacks in the provided information. This suggests a focus on retaining earnings for future growth and development rather than returning value to investors through dividend payments or share repurchases. That concludes the financial summary for DPC DASH. Feel free to comment below, and I will be happy to answer them when possible.